Hi, I'm Richard Murphy, and this is the ninth in the video series on the importance of tax transparency. In this video, I will discuss the choices available to a government, a treasury, and the tax authority that advises both of them when it comes to raising taxes. The most commonly available tax bases that are available to any government are income, employment, corporate profits, transactions, wealth, and other special cases. In this video, each of these will be discussed, even if briefly, within the context of financial transparency and the need for any state to be clear about the objectives it has when charging each of these possible areas to tax, including why they might not want to tax these things. Income taxes are in many countries the largest source of tax revenue. They can be charged on employment income, profits from self-employment, unearned income including pensions, investment returns of all sorts including interest, dividends, trust distributions and more, and maybe on overseas remittances. In principle, these are great sources of tax revenue. In practice, there can be really big problems arising as a result of casual employments, unrecorded self-employments, people simply not making enough to pay tax, literacy-related issues, and enforcing collection. The result is that these taxes tend to be focused on higher paid people, people who work for the government and larger companies, and easily identified sources of income such as bank interest. Otherwise, evasion can be all too easy. In addition to income tax, employment taxes can also be charged. These are taxes paid by either employees or employers, or both, on top of income taxes. The problems with such taxes arise when much of the employment in a jurisdiction is of a casual nature. As a result, these taxes tend to be charged on higher paid people who work for the government and larger companies. This can in some cases mean that it is easier to build these tax charges into the income tax system as a whole. These taxes can sometimes be called social security contributions. They can also be designed as payroll taxes. Companies can be another good source of tax revenues for a jurisdiction. Taxes can be charged on their sales, their income or profits, their capital gains, and their distributions to their shareholders, for example, by way of dividends. The bigger the company, the easier it is to tax. The most common problems with corporation tax are knowing which companies are trading in a jurisdiction. Overseas and tax haven companies are a big problem when determining this. Getting reliable accounting data from companies, the existence of a strong accounting profession is key in this regard. There's also a problem of tackling transfer pricing abuse on the intergroup trading of multinational corporations, which has been the focus of much attention in recent years from the Organization for Economic Cooperation and Development and others. That's the OECD in common terms. Tax transparency is key here. It requires, when it comes to corporation tax, well-run company registers, so that it is known which companies are in existence in a jurisdiction. The public filing of accounts, so that standards of accounts reporting can be maintained. Country-by-country reporting by multinational corporations, so that their use of tax havens can be identified. These may be aspirational objectives, but tax transparency is all about setting directions of travel for taxation policy. In practice, many countries do have considerable problems collecting the direct taxes on income that have been described so far. As a result, they often use and need transaction taxes to collect the money that they require. These taxes can be charged on domestic sales. These often take the form of value-added taxes. There can also be specific transaction taxes on things like land and buildings, financial transactions, and contracts, often in the form of stamp duties. And targeted taxes are also possible, e.g. on tourists. Imports and exports are also a common indirect tax base and include customs duties and tariffs. In many cases, these taxes need to be designed to suit the particular needs of a jurisdiction. There is also a very big need for transparent decision-making on these processes of decision-making if these taxes are to work as intended. Wealth taxes are another source of revenue in some jurisdictions. These can include taxes on income from wealth, such as investment income of all sorts, capital gains, whether those of individuals, trusts, or companies, gifts between individuals or trusts, and wealth itself. In addition, arrangements associated with wealth, such as trusts and foundations, can also be subject to tax. The most common problems with wealth taxes are resistance to the introduction and operation of these taxes from the owners of wealth, capital flight, the use of tax havens, actually identifying the existence of these tax bases as a result, estimating the value of the wealth that will be subject to tax, actually collecting the tax due. That said, as a part of an approach to tax transparency, a jurisdiction should discuss its policy on wealth taxation, even if it decides not to charge them. Then there are other special cases when it comes to taxation. These arise because of the particular significance of certain types of activity within a state. They are, for example, most likely when some specialist industries are found in a jurisdiction. One of these might be the extractive industries, whether they are extracting oil, gas, minerals, timber, or fish. There's also a particular problem with regard to IT industries, and there are special issues that have arisen around this sector that have been highlighted by the OECD and the UN, especially when international dimensions are taken into consideration. And tourism can be another opportunity for raising special taxes, especially when there are specific charges that can arise from airport taxes to landing fees and hotel taxes, which can all be charged on tourists who are pretty much a captive audience. How a tax jurisdiction addresses these issues and the resulting overlapping matters that arise is a big issue in tax transparency, requiring disclosure on what the policy on each of these issues is, where the country stands on international tax cooperation on them, how it sees its obligations with regard to tax treaties, and why it is choosing to tax in non-standard ways, if that is the case. What, however, should be clear by now is that, as this module shows, there is a great deal for any jurisdiction to decide upon when it comes to deciding what to tax and on whom. That's why tax transparency on these issues is so important. It is also why we will look at many of these issues in more depth later in this course.